Welcome everyone to the re-recorded version of the SMCP section number 10, Tax Planning. As many of you've known and as many of you've sent us emails, some business owners are concerned about some of the changes coming to at the federal level on tax planning. So that is why we invited Jordan Anderson from A1 Accounting in Saskatoon to revisit and re-record the SMCP webinar. Without further ado, Jordan, I'd like to turn it over to you.
Thanks, Allison. Yes, like Allison said in introduction, this is a rehash of some of the changes that we know this fall, actually this whole summer has been kind of interesting. Lots of changes, lots of proposed changes. We're still waiting on a couple details, but at this point, late December, there was definitely a bunch of clarification, and now going into January, we know what programs are coming and when, which is a big improvement from the last time this presentation was done. So I'm going to talk briefly about the tax changes, probably the first solid half an hour, or not the first solid half of the presentation. It's not going to be an hour-long presentation. The first solid half of the presentation will be about some of the tax changes that are coming. Then I'm going to spend about 15 minutes or 10 minutes talking about some of the accounting considerations to make when you're looking at buying and selling a business. And then I'm going to spend about 5 minutes at the end briefly talking about the inherent conflict between an asset, between the buyer and seller, and that predominantly affects corporations. And it's mainly the difference between an asset sale and a share sale. So we'll get into the tax changes as we know them now. Where are we? Like I said, we're not 100% sure on most of this. Anyone who claims to know exactly what's coming, I'd like them to give me a call and let me know, because that information would be invaluable right now. You could make all kinds of investment and business decisions based on some of these changes that are coming. Although the government's been pretty good over the last month at telegraphing where they're going with it, and doubtfully they're going to get more aggressive than what I'm going to present, and they might even still back off a little bit before the next budget. So the government has proposed a passive income tax. This was, to give you a little bit of the history on it, this was originally any passive income earned by a corporation was going to be taxed at an unknown rate, but predictably higher. Some even proposed it could be as high as like 80% effectively, making it totally worthless to save any money in a PC or company. This is one of the main points that had the Chambers of Commerce's and such, Canadian Federation of Independent Business and such, fight so hard against the federal government on these proposed changes. It looks like they've rolled this back. We still don't know the exact details of the program. There was originally, the finance minister mentioned that it would be $30,000 of income earned. That rose questions of whether it was $30,000 per shareholder or per company or per group of companies. And then Ralph Goodale, in an interview in late November, early December, mentioned that it would be $1 million of invested assets. And that's kind of currently what the literature appears to be. It seems to be that they'll allow you to keep about $1 million for investment. So this is like, let's say you had a company with $1 million of cash in it. That $1 million of cash might not be passive income if you're holding onto it for legitimate business uses. Let's say throughout the year you're farming, and you know you spend $1 million putting your seed into the ground, and at the end of the year you sell it and you get your cash back out. That's not passive income. What we're talking about is you're saving some money, let's say, to buy a new building, and you know it's going to cost you $2 million. And at this point, you've saved $1 million for it. And instead of that money just sitting there as cash, you buy GICs, maybe you get a little bit more aggressive with stocks. You're doing some type of investments over and above, you know, basically cash sitting there on the balance sheet. It's the income off that up to $1 million that would possibly be taxed at this new higher rate, although the exact details of that haven't been fully disclosed. this comes into concern if you've got, like I said, $1 million invested. So we'll keep an eye out for that. The next thing is to talk about income sprinkling. This has got to be one of the ones that confuses most accountants, particularly any accountants that have a little bit of experience, because most of us feel like this has been hashed to death over the last 30 years, and we thought there was pretty sound rules about income splitting already. About 30 years ago, they took away the ability in the 90s for companies to be able to have minor children as shareholders and earn income, and they invented a so-called kiddie tax. And this meant basically any income passed to a dependent child under 18 years of age was taxed at the highest marginal tax rate in Saskatchewan, say about 47%. Some provinces like Ontario, that would be like 51%. So this so-called kiddie tax kind of got rid of it. Like, it made the use of trusts and minor children owning shares for tax planning purposes no longer really a feasible plan. There's still some things around disability tax trusts and a few things like that, but generally speaking, minor children don't tend to own shares in family corporations anymore for these reasons. The next thing, about 20 years ago, they got more aggressive on defining who you could pay a salary to. So obviously, when people could no longer pay a dividend to their children, they started hiring them, particularly children and spouses, as employees. And they'd say, well, my kid helps out, around the farm. I give him $50,000 a year, or I give him $10,000 a year. 10,000 was a really common number because basically they could take that money tax-free out of the corporation or the business, because that was what their independent personal tax exemption was. So you could transfer the kid. It's been growing, so between $6 and $10 grand, depending on what year it was and when. You could transfer him that $6 to $10 grand tax-free, and that looked really, really nice. And same thing with a spouse. Or if you were earning $80,000 and you had a spouse who was earning nothing, you could transfer them $40,000, and you can keep $40,000 and enjoy a lower tax rate. Government, through various court action and so on and so forth, set up grounds of reasonableness, and now it basically stands, if you're going to pay someone who's not arm's length any sum of money, you need to reasonably be able to justify that you would pay another non-arm's length person the same thing. So if you're going to hire cleaning staff for your office, and you're going to pay them $40,000 a year, well, then you could pay your spouse $40,000 a year to clean the office or something like that. But if you'd only pay, say, a cleaning staff like $5,000 a year, then you're going to have a tough time justifying paying your spouse $40,000 a year to do that task. Or bookkeeping is another really common one. I don't know how many clients I've got where what you're supposed to do for the business, oh, they're the bookkeeper. It's like, oh, okay, well, that makes sense. So they apparently answer the phone and do all the bookkeeping, and they earn a pretty healthy salary. Some of them very healthy salaries, but it's justified because they're the bookkeeper. And so that's where we stood, and we thought that was fairly clear, except for with these new rules. They're not touching the wages and salaries because those rules already exist. They're touching adult children and spouses and them earning a dividend. So you would, it's fairly common practice if you're setting up a corporation to make adult children a preferred shareholder or a non-voting shareholder, or perhaps even a voting shareholder, and hold some type of minority stake in the corporation. It's those dividends paid out. Let's say the kid comes home and helps seed or whatever, and you give them $10,000 of dividends. It's those particular payments that are going to attract this same kiddie tax. That's what you're going to hear it referred to as in the news. That's not the technical term for it. But you're going to hear it called the kiddie tax, K-I-D-D, like not kitty if you're praying like crib or something, but like kiddie as in small kids. Anyways, you're going to hear it referred to as that tax, and it's going to be taxed at the highest marginal tax rate. A bunch of accountants and clients and lawyers already promising to fight this in courts. So we'll see if this stands. There's a couple things they've said that if your spouse is older than 65, it won't attract this tax. There's been talk about particularly taxing kids between 18 and 25 who are at university. So we'd have to justify if that's full-time or part-time. And I personally have a tough time believing that would stand up to a charter challenge, because I can't understand how you could pay, $10,000 for helping seed and harvest to kid A who happens to be going to university, but kid B who happens to be 26 or happens to be a welder, you can pay him to. It seems like a bit of age discrimination to me there, and that's obviously against the Charter of Rights and Freedoms in Canada. So we'll see how that plays out, but that's going to be, 10 years down the road. So in the meantime, there could be some additional taxes attracted by these dividends. And that's an aside from the current rules around dividends and eligibility of dividends and when you made them shareholders and so on and so forth. But basically, those announcements are expected to come down and be solidified with the next budget. So March, April 2018, something along that lines, perhaps sooner, but realistically probably not till March or April. So those are the two big things that people are talking about with the coming changes. Everything else appears to be frozen or put on hold. There was going to be a tax possibly to the sale of shares to non-arm's length individuals. That appears to be put on hold. There is one other interesting tax change that has caught no media attention. There's no logical reason for it, and all the literature I've read from other accountants and my own personal belief is it's purely a politically motivated movement. Is they're basically gutting the voluntary disclosure program, which was a program that if through a fault or omission you realize you'd made some type of error on your tax return, you could disclose that to the government before they caught it or asked about it, and they would let you just pay the income and the interest virtually penalty-free or almost always penalty-free. So if you were going to sell your company, let's say, like, why is this important to you? You're going to sell your company, and while you're doing your due diligence on your books and you're cleaning up your balance sheet and that kind of stuff, you realize, oh, I actually cleared out all my class 10 assets, and I don't actually have anything with a wheel anymore in my company. Oh, I should have declared some recapture or something. And your accountant tells you, oh, that's going to be an extra $5,000 or $10,000 of tax. And you're like, okay, I'm going to write that bill, but you should have made that declaration 2 or 3 years ago. Well, you could be looking at a 20 to 50% penalty for not declaring that. The government, up until March 1st, would let you make that declaration most of the time penalty-free. What they're proposing is you can still make the voluntary disclosure. They want you to send in a check with the disclosure for the amount of the penalty. They'll spend some time reviewing it, and depending on whether or not they accept the disclosure in the auditors, like the person who opened the mail's opinion, they may or may not refund that penalty. Getting money out of the CRA is difficult at the best of times, and considering a lot of these voluntary disclosures tend to take 2 years to process, that could mean the government's sitting on your penalty, which they'll pay back to you for up to 2 years. So you've given the government a nice little loan for a couple years. There is a possibility with them gutting the program, it's going to have an ostrich effect to where people aren't going to be willing to write that check, and instead they're just going to say, well, screw it, if I can't get out of the fines and penalties, let the government catch me, because there's literally no incentive for them to voluntarily disclose this, which was the whole point of this program. So with that incentive gone, people are going to tend to fail to report this, in my opinion, and that's not good for the system as a whole, because it means the CRA needs to spend more time auditing people to try and find this information. And all the people that they audit that have nothing to disclose is just a giant waste of everyone's time and effort. But I think that's going to be the mantra for accountants for the next 2 or 3 years, saying that to their clients over and over again, as they've spent almost $500 million hiring new auditors and putting in new computer programs and algorithms to look for tax avoidance. They're going to be wasting a whole bunch of people's time. For instance, myself, I've got a relatively small firm with only 3,000 clients. I have fielded 5 phone calls from GST in the last month asking if my clients need GST numbers set up. Any one of them, creates an hour or 2 of work because I've got to figure out why they're calling. For instance, one client was the government informed me that they own the Saskatoon Jazz Festival, and I was like, well, that's insane. He definitely doesn't own the Saskatoon Jazz Festival. Why would you think that? It took 2 or 3 phone calls and wasted an entire day. We determined that what she was looking at was he was on the board of directors in '96, and because he was on the board of directors, she felt he had some type of ownership stake in the Saskatoon Jazz Festival, and as such should have a GST number because he obviously makes millions of dollars. Meanwhile, he's a sessional musician earning under $30,000 a year with a little bit of teaching income on the side. So he definitely didn't need a GST number, and the government proceeded to waste a day of my life and my client's life for absolutely no gain. And so far, they're batting 0 for 5 trying to set up GST numbers for my clients. And if that's me, I imagine that's most accountants in the country. In fact, one of them, we politely told them he did not need a GST number because what he was selling was GST exempt because it was a medical product, and they proceeded to give them a GST number anyways. So now we have to waste our time and energy to close down the GST number because in this particular case, for what he was selling, it wasn't a zero-rated item. It was just a GST exempt item, so he didn't qualify for ITCs. And as such, the government, again, just wasted a bunch of our time. So I unfortunately think that's going to be the mantra for the next 2 or 3 years as they try and find these tax savings. They've proposed, I believe the last number I saw them is they're trying to raise an extra $250 million or something out of the economy for tax people avoiding paying their taxes. But I shudder to think of what the cost of the economy is on that because I think it's going to be quite huge. Anyways, so that's what I'm going to cover for tax news. If you're still with me and you're not asleep, we're going to get to some more meat and potatoes types accounting about accounting before a business sale, what you need, want, or thinking. So you're thinking of selling and what you need to do. Most people, when they think about this, they think of their income statement. They're like, oh, I make a profit, and they kind of look at expenses and they move unreasonable expenses off the income statement and that kind of stuff. And what I propose is most people don't pay nearly enough attention to their balance sheet, and it's a balance sheet that usually needs the most TLC trying to get fixed up before a sale. Well, why would your balance sheet have something on it? For one thing, are all the assets on your business and all the liabilities on your business balance sheets actually government or business related? I know you're a mobile welder, and sometimes you need to get to remote locations so you can justify that side by side, or maybe you have to weld a buoy and you need that jet ski or something for the company. But I think most businesses can look around and find assets that have been acquired by the business that probably, when they were bought, actually had a definite business use, but because of change of contracts or change in just direction and staffing level, those assets may have become personal. RVs, if you're a construction outfit and you bought some trailers so you guys can be on the side of the highway and work on but now you're doing all in-town stuff or something, there could very well be assets that shouldn't be there. Old assets. A lot of people add to their assets sheet. They keep on adding, but they fail to report to their accountant or their bookkeeper when an asset is no longer needed. This stems from the fact that most private business tends to depreciate assets at the same rate as a CCA schedule on the tax return. So they're not, their financial statements look identical to their tax return, which might not always be the case for a publicly traded company or someone who's using IFRS. But most companies still using, Canadian standards for private enterprise are likely depreciating just at the CCA schedule, or they're a not-for-profit, or they haven't paid tax because they haven't shown a profit yet, and maybe they've taken no depreciation on assets that have no useful life left. This could be true for patents. This could be true for physical, like computers and desks and cars and trucks and all kinds of things, like that old 86 Chev that you bought and you ran into the ground 20 years ago, but it's sitting in the back corner of your compound. That can probably be written off the balance sheet if it's still listed, or anything, that power washer you bought that's been frozen up for the last 2 winters and is totally useless, but it's still got some value for depreciation. The person looking at buying your company probably doesn't care about that, and you can strike that off your balance sheet. Then moving on to liabilities. Those shareholder loans or employee loans you could have on the balance sheet. Besides tax reasons why they need to be struck off, the owners the new buyers aren't probably interested in continuing to have lent you money for your mortgage, or perhaps aren't interested in, whatever particular program you've been using for how you've been paying yourself with possibly a combination of shareholders loans and drawings and combinations of dividend and wages. I would propose that shareholders loans should be paid off and struck off. Old taxes or future taxes or other the PST, GST payroll taxes, those should all be caught up and current and listed and appropriately notarized. I know a lot of you possibly do your own bookkeeping, and it's not uncommon for me to see a GST liability and a GST asset account, because the GST collected by default in a couple accounting packages goes to one side of the balance sheet, and the liability goes to the other side of the balance sheet. And this tends to create this weird math where you have to subtract one from the other to figure out what your actual GST balance is at any given time. That's okay. It makes sense from a bookkeeping perspective, and I know you're doing what the software is saying, but realistically, those should get cleaned up to zero on your balance sheet, or those PST commission payments that you never quite knew what to do with, that don't exist anymore, but quite often would leave you this weird balance in PST, and they would carry forward for forever and a day. Those balances and that kind of stuff need to get cleared off. The other concern and consideration is loans or transfers between related corporations, holding companies, anything like that. If you've been bleeding cash out of a company to an investment company to purify the balance sheet over the last number of years, or if you've lent your holding company money so that they could buy the building you're in, or things like that, those types of related companies either need to be amalgamated possibly into the operating company, or fully divorced, or appropriate action needs to be taken anyways. The balance sheet should look relatively clean, kind of operating bank account, operating assets, operating liabilities, and owner's equity. That should be, fairly straightforward. That will make the sale just go smoother, as there'll be far less questions than, a balance sheet which should have 6 lines on it having 50 lines, and that's routine. I see that often, where there'll be a shareholders loan account and then a Visa, like shareholders Visa, shareholders MasterCard, shareholders auto loan, shareholders this, that, and everything. And it just gets to the point where it's like, come on, guys, like this should all just be wrapped up. Why are you presenting this like this? It's a waste of everyone's time. But anyways, concerns and considerations for you as you're getting ready to clean up your books before a sale. Okay, so those are your main concerns. I know the last time I also talked about knowing some of the ratios in that for your company, such as what your cost of goods sold are, and what inventory you actually have on hand and what inventory is still good. General ratio analysis. I've been talking with Allison about some due diligence from some purchasers and that kind of stuff, and I firmly believe ratio testing, the stuff that CMAs used to be their bread and butter, is neglected to some degree in modern accounting. I think a lot of people spend all their time looking at net bottom line and being like, this business is profitable. They don't spend nearly enough time asking why. If the business has 2 or 3 main sources of income, maybe 3 of them are duds and only 1 of them is making any money, and that's particularly important. Particularly if that one that is making money is heavily tied to the proprietor, who may be leaving and may not be staying around after the purchase. So identifying what the sources of income are, what the true expenses are to those sources of income, and their ability to still be sources of income after the change. That management accounting side, I honestly think some time needs to be spent on it for any business purchase, and new costing needs to be done up, and realistic costing, and sometimes you'd be amazed. A company's been doing the same thing. They've been making the same widget for 20 years, and the owner kind of knows he makes a profit at it, but the last time he actually did a costing analysis on it, the component A for the widget was 5 cents, and now component A for the widget's $1. He might not have shopped around for a low price supplier. That supplier might be getting pressure to no longer sell to them at that reduced price. If there's a new owner coming along, I saw that with a construction company 2 years ago, where they had a crazy price on raw materials that no one knew why the price was that low, and they continued to sell at that price. But when the new owner came along, they jacked up the raw material price by 20% to their current market standard, just because no one could justify the super low price they had been selling the raw materials at. So it was kind of an interesting, discussion that needed to be happen between the various sales reps and management and so on and so forth. That brings us to the last point: share sales versus asset sales and timelines. Your accountant would really like more than 2 years before you're going to sell to really look at your books. There's a couple different strategies, accounting-wise and that kind of stuff, that need a minimum of 2 years to solidify for various legal reasons. Plus, there's things like, if you got a $150,000 shareholder loan that's kept up on you, you don't want to have to pull that all out in 1 year. Perhaps it would be smarter to pull it out over 2 or 3 years. So the more time you can give your accountant for a sale, the better. Give them the heads up that you're going to be selling, and then what the plan and the strategy will be going forward. And then let's say if your accountant has you set up for a share sale and you get an asset offer, if you've got a plan in place, you'll know what that means to you tax-wise, because someone giving you $2 million for the assets in your company is radically different than someone giving you $2 million for the shares in your company. For instance, if you're a farming operation and it's a husband and wife, and you're offered $2 million, there's a fairly decent possibility that that $2 million is tax-free, aside from minimum taxation, a couple of things. But basically, that $2 million can be tax-free versus $2 million for, let's say they just want to buy the land and they don't actually care about the farm at all. Well, then that $2 million could be heavily taxed, particularly if they had inherited that land 40 years ago for a song. Suddenly you could be looking at paying, fairly substantial tax on, half that capital gain. So 2 years minimum. I have this changes here. This slide is the one I actually blanked out because this is where I was going to talk about how they propose to get rid of pipelining and certain changes to how you could transfer a corporation off to related parties, or even not just related parties, but quite often it's related parties by setting up a loan and a holding company and paying it back. But I'm getting rid of, obviously I've deleted this slide because those changes appear to be gone. And for this point, at this point anyways, the government seems to be leaving some of that succession planning to your own family alone. So there still seems to be estate freezes and pipelining and all that seems to be good, which is particularly important if the owner of the corporation has the misfortune of passing away before any type of succession planning can begin, because that can create situations of double taxation and horrendous situations where if you have the misfortune of passing away before you've got a succession plan in place, it can be like the difference can be hundreds of thousands of dollars. I just dealt with one about a month ago where there's an interesting situation. The person opted to use the new laws about ending your own life and facing a second battle with cancer. We were able to get his tax bill down to $120,000 for his corporation when passing, versus had he passed away and the pipelining rules were gone, he would have been facing about $350,000 in taxes. And had the family and the CFP involved allowed me to be more aggressive, we could have actually probably got that taxation down even lower. But using pretty safe tax planning, we were able to reduce his tax bill by $200,000, and that appears to still be in place. Anyways, so that is a brief 30 minutes or so on taxes and the changes of taxes, and it is true as of January 5th or so, 2018. Who knows what happens Monday morning when the market's opening again, but most of what I just told you is factually accurate for the time being.
Perfect. Well, thank you so much, Jordan. I know that's a lot of information. I know lots of people may have some additional questions. So if you're watching the recording of this webinar, Jordan's contact information is in the comment section of this video. We also encourage you to reach out to your own accountant if you are thinking about selling your business, like he said, and just giving them a heads up, because it's the difference between a lot of different strategies and could save you a lot of time, effort, and headaches. So big thank you again to Jordan from myself and everyone at Succession Matching. And like I said, if you have any questions, you can find his contact information in the comment section of